Welcome to the Daily Drawdown, where today the pressure points are memory, AI spending, and rotation. The market's leadership is shifting fast. The clean version is simple. Memory is tight. AI spending is getting harder to justify on faith alone, and money is moving away from the biggest winners into the suppliers, infrastructure names, and smaller parts of the market with clearer payback. The most immediate pressure point is memory. DRAM and NAND prices have jumped hard, with DRAM in AI hotspots reported up roughly five-fold year over year, and that has lit up names like Micron, Western Digital, Seagate, and the memory ETF, while broader semiconductor funds have basically gone nowhere. Why it matters is margins and pass-through. Micron's DRAM gross margins have been cited around 85% versus roughly 50% a year ago, which tells you pricing power is very real and downstream buyers are now absorbing it or passing it on. We're already seeing the pass-through in product pricing, with Apple raising prices across parts of its lineup and Microsoft lifting Xbox pricing as component costs move higher. For hyperscalers, the issue is bigger than device pricing, because expensive memory changes the economics of AI buildouts and forces another look at capex plans. The tightest part of the market is high-bandwidth memory and other AI-specific memory. Industry estimates point to shortages lasting through 2026, with only modest relief before larger capacity additions start showing up closer to 2028. That timeline matters because memory does not expand quickly. New capacity typically takes about 2 years to ramp, so when demand spikes all at once, prices can overshoot, margins explode, and then the cycle can break just as sharply once supply catches up. What to watch next is whether buyers keep accepting these prices or start delaying deployments and redesigning systems around tighter memory budgets. There is a possible pressure valve, but not an immediate one, and that's China. Chinese suppliers are cited at around 13% share in NAND for YMTC and roughly 8% in DRAM for CXMT, and they can undercut incumbents by as much as 30% on price. That is enough to make US OEMs reconsider sourcing, especially with Apple expected to need materially more working memory for future AI features. The catch is qualification and regulation. Bringing on a new memory supplier can take 12 to 24 months because of reliability testing, security review, and export control risk. So even if buyers want cheaper supply, near-term relief is limited. That feeds directly into the broader market rotation. Investors have been pulling money out of concentrated Mag 7 exposure and moving towards small caps, cyclicals, financials, industrials, healthcare, and equal weight indices. Bank of America flow data showed a record roughly $9.3 billion out of the Mag 7 group in the month, and performance compression has been severe enough to force real multiple contraction in some of those names. The message from the tape is that the market wants nearer-term return on invested capital, not just very large AI narratives with distant payoff. That is why suppliers tied to bottlenecks like memory, semis, optics, and power infrastructure are holding attention better than companies asking investors to fund giant capex plans on trust. This is the other major practical shift. AI-related capex is projected by some estimates to rise from about $765 billion today toward $1.6 trillion by 2031, and the market is starting to ask the obvious question: when does that spend produce durable cash flow? If monetization lags, free cash flow and returns on capital get hit, and valuation pressure follows quickly, that scrutiny extends to private AI leaders too. OpenAI has filed confidentially but still signals no fixed IPO timeline, with some reporting pointing as far out as 2027, and investor caution makes sense when a company is targeting an enormous valuation while still reported to be deeply unprofitable. As the market gets more selective, two second-order AI trades stand out: optics and energy infrastructure. On optics, Coherent is quadrupling indium phosphide wafer output in Texas to relieve laser bottlenecks, and NVIDIA has put real money and purchase commitments behind co-packaged optics. The reason is physical, not thematic. At higher data rates, copper hits limits, so the industry has to move more aggressively toward optical links closer to the silicon, which broadens demand for lasers and optical components across data center architecture. On energy, AI data centers are increasingly leaning on natural gas-fired turbines and on-site generation, creating a steadier demand channel for gas and pipeline operators. That gives midstream and power infrastructure names a lower correlation way to benefit from AI spending without relying on model pricing or consumer software adoption. On macro, the backdrop is less dramatic but still important. Fed rhetoric remains relatively hawkish even as oil and some inflation pressures ease, and longer-term yields remain elevated with the 10-year around the mid-fours in recent coverage. That keeps pressure on duration-sensitive assets, but it also creates room for selective bond opportunities if growth expectations soften faster than the Fed's language suggests. Oil itself has weakened, with WTI slipping below $70 a barrel despite drone-related risk around the Strait of Hormuz. The market is leaning on solid supply and the belief that flows continue, but shipping and insurance costs are rising, and that matters because higher transport premiums can keep refined product price floors firmer than spot crude alone would imply. The main beneficiaries of the rotation have been small caps, healthcare, biotech, and other areas less tied to hyperscaler concentration. Equal weight and the Russell 2000 have outperformed large cap growth in coverage, and biotech has been especially strong with M&A and a better FDA backdrop helping redirect capital into life sciences. Consumer demand has also held up better than many expected, supported by jobs, wages, and lower energy costs, which keeps a floor under travel, restaurants, and parts of discretionary retail. That's relevant because it broadens the market beyond one AI trade and gives investors more places to look for earnings support. The risk list is straightforward. First, memory pricing can stay tight longer than expected, but if capacity comes on into softer demand, the boom can reverse fast. Second, AI leaders still need to prove that all this capex earns its keep, and the market is getting less patient. Third, credit spreads remain tight, which is supportive until it isn't. So any sudden de-risking can hit crowded equity positions and lower quality credit at the same time. And fourth, oil weakness is not the whole story if Hormuz-related insurance and routing costs keep rising underneath the surface. That's the standing brief for the daily drawdown. The market still likes AI, but right now it's paying up for bottlenecks, infrastructure, and clearer cash flow math. This episode was generated by Podkey. Create your own at podkey.fm.